Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.23, which is down about 3 basis points from last week's 6.26. It's very likely that we are going to get a rate cut at the next Fed meeting, which is December 10th. And when we get over to the charts, we are going to detail everything that's been going on in the macroeconomy to lead up to that. So let's get on over to the charts. So as you can see, the rates have really been bouncing in between this area right here, about 4.2 down to a little below 4 at 3.933. They've been stuck in this range, which makes sense to me. I heard someone discussing the comparison between the 2-year and the 10-year, and I believe the 2-year is, the Fed funds rate. I could be wrong on that though, so don't quote me. But the difference between the Fed funds rate and the 10-year typically has like a spread of like maybe like 1% for the predicted floor, which is roughly like 3% for the Fed funds rate in 2027, so it doesn't make much sense for the 10-year to drop too much lower. But, we are monitoring this because, a lot can happen between now and 2027. But anyway, this is just to show that the 10-year, which is obviously, what we are using to determine rates, really fluctuating between, like I said, about 4.2 to on the low side of things, right under 3.95. Looks like the rates today got a little bit worse, so that's definitely something to monitor. It's definitely a volatile financial market right now, so a lot can happen with the equities, the bond market in general, right? It's So if we take a look at the TLT, which is what we use for the bond market, we can see a very pretty steep drop off right here, and that's where you would be seeing this uptick in the 10-year. So, as long as the bond market doesn't drop down below this area right here, right? So as long as we can sustain this floor, which we can see right here, we should be in good shape for the 10-year, and rates should not rise too much. All right, so let's get on over to the economic activity. Last week we had PPI, retail sales. Let's see, core and normal. Now this was delayed data because the government shut down. I believe the statistical system was damaged. It's kind of funky with the data, but we do have this PPI. I don't know for what month this is for. I don't know if this might be October. It's either October. No, yeah. I believe this is October. Anyway, so we had core PPI 0.1, so that was a good beat, though it was higher than previous. And then we had normal PPI, which was about what was expected, still higher than previous. Retail sales coming in as expected, but there was a drop off from the previous month's retail sales. And then when you exclude the core, and I know the core, let's see, I want to say this is probably like automobiles automobile sales. So core excludes automobiles. So retail is outside of that. And yeah, that spending was down a little bit from previous, but also the expected. Pending home sales, this was up, so 1.9%, forecast a 0.5%, previously 0.1%, so pending home sales up. That's really good for the mortgage industry. And then let's see, what else do we have? We had unemployment claims, so labor data that we really hadn't been seeing for a while. This actually came in lower than expected, 216 compared to an estimated 226. So we know that the Fed has to balance the labor market with the inflation. So really, that's their dual mandate: make sure that the labor market does not deteriorate and make sure inflation can come down. And that is really what the narrative driving the Fed rate cuts. It's looking at the balance between labor and inflation right now. So really good news can be bad news in terms of labor. But as we'll get to in a little bit, it looks like we're more than likely still going to get a cut on December 10th. So as of this morning, December 1st, ISM manufacturing PMI. So this is the manufacturing side of things from the Purchasing Managers Index. So it's a survey of purchasing managers looking at how manufacturing is doing. So it looks like there's a contraction. Anything above 50 is expansion, below 50 is a contraction. So it looks like manufacturing is taking a hit, and this is monthly, I believe. Yeah. So prices, let's see. Yeah, above 50 is rising prices. So less manufacturing, rising prices. Not great for manufacturing. Powell speaks tonight at 8 p.m. So that can impact things for sure, but it is not a press conference specifically for like FOMC. So probably nothing too big of a deal. We do have ADP non-farm employment change. So this will be interesting to look at Wednesday, December 3rd. Services PMI is pretty interesting because, America is more of a service-based economy rather than a manufacturing-based economy. So to see how services is doing is really going to let us know how prices and everything are doing for services, and, is that still there? Is there a contraction or an expansion in terms of services? Then we have unemployment claims, and then we have core PCE. So this is the preferred gauge for inflation for the Fed. And then we have University of Michigan consumer sentiment. So these are all things that really contribute to this volatile market right now. So, really it's most of these days other than Tuesday. So Wednesday, Thursday, Friday, we can really see probably big jumps in the interest rate. So these are all things to keep an eye out for. Like I said, 6.23 down from 6.26. Still not quite as low as at the end of October, which was 6.17. So far, that has been the lowest of 2025. Yep, so 6.17. Now, if we take a look at the probabilities of a rate cut for December 10th, 87.6%. This can change, of course, with as more data comes out, these numbers can fluctuate for sure. But right now, it is likely that there are going to be rate cuts. An important note on this, definitely something I've said before, so I'll sound like a broken record, but the interest rates, I don't believe they are going to come down substantially with a Fed rate cut, because when the probabilities are like this, where it's like an 87, 90% chance, 95% chance, the investors are keyed into that already, so they are going based off of the expectation that it will already happen. So that's what causes buying and selling, right? It's the expectation of what's going to happen, and so if everybody already knows that there's going to be a Fed rate cut, it doesn't make sense for the rates to drastically drop unless something is said during the press conference, which is not known information. So that's something to keep in mind with these rate cuts, right? Just because there's a Fed rate cut does not mean that the 30-year is going to like 1% again. That doesn't mean that you're definitely going to see those low rates from 2020. All right, that's about it. If anyone has any questions, feel free to reach out to us at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. All right, hope everyone had a happy Thanksgiving.